Well, that really depends on the terms that you're being offered because you have to make an analysis of whether the extra costs of paying a fixed rate right now, when rates are expected to stay low until the second half of next year, is worth the insurance that you're getting for higher rates further out in time.
I'm Natalie Nanowski, and this is Scotiabank's Midweek Exchange, where we break down this week's big economic issues and what they could mean for you. Brett House is here to help with all of that. He's Scotiabank's VP and Deputy Chief Economist. Hello, Brett.
Good to see you, Natalie. There's a lot going on.
There is a lot going on. And of course, housing has been a big topic during all of this pandemic. And we just learned that household mortgage debt grew by $18 billion in April. And of course, this all comes as the Bank of Canada has hinted that borrowing rates in 2022 are going to go up, as opposed to going up in 2023 as the bank had originally planned. So, should Canadians think twice at this point before they take out a loan?
Well, taking out a mortgage should always be a very considered decision that reflects a thoughtful conversation with a financial advisor on what an acceptable or sustainable level of debt is. That said, interest rates are at some of the lowest rates they've been in 40 more years. And that provides a real opportunity to lock down what are very affordable borrowing costs. It also provides an opportunity to actually decrease interest costs on some mortgages. Those who took out a mortgage 5 years ago can actually renew a mortgage now in many cases at a lower rate. And in some cases, use that savings to take on a bit more principal to finance renovations. So, there are ways in which taking on more debt right now can be a very cautious and thoughtful economic decision.
So is that your way of basically saying that locked in rate right now is better than taking on a variable one?
Well, that really depends on the terms that you're being offered because you have to make an analysis of whether the extra costs of paying a fixed rate right now, when rates are expected to stay low and not move until the second half of next year, is worth the insurance that you're getting for higher rates further out in time. And in order to assess that, you have to look really closely at the terms of the mortgage. And if you were to take a variable rate mortgage, what the costs of breaking it would be to move into a fixed rate mortgage if you see interest rates going up a little more than you were expecting.
Moving to inflation right now, it is up about 3.6%. And that is also the highest level that we've seen in about a decade or so at this point. And most people are seeing this reflected in the price of food and gas. Last June, the price of gas was about 99 cents a liter. This June, it's already at $1.20. How much more do you expect the cost of certain basic goods to go up?
Well, this question is really closely related to the one we just had about mortgage borrowing and interest rates. The whole reason that the Bank of Canada is saying that interest rates are likely to go up in 2022 rather than a year later is because we're seeing inflation come up, we're seeing economic activity reopen, and we're seeing vaccinations rolled out far faster than we expected even 6 months ago. Those gas prices and food prices are always the most volatile price parts of our consumer basket. And when the Bank of Canada is making decisions about interest rates, they typically look through those because they do bounce around month to month an awful lot.
And anything we should be looking out for in the next week in terms of interest rates and inflation?
We're really focused on how the continued vaccination rollout is progressing. We are set to catch up to the United States in the next couple of weeks. That's a real sea change from how things felt a couple months ago. We've had the announcement on the border opening up. That is going to start changing flows of goods, services, and people, and have some big implications for service sectors in the economy that have been dormant. We're going to be watching how they start responding and what that means for the economy as a whole.
Thanks so much, Brett.
It was great to speak, Natalie.
Great to speak to you too. And we'll have more midweek exchange coming up next Wednesday.